US dollar liquidity is getting tight again. I wrote about this on LinkedIn a couple of days back. But this topic is getting far too interesting, and there's a lot of coverage in mainstream media as well. And hence, this topic deserves a video in itself. For the unversed, in simple words, there needs to be an adequate amount of greasing on the wheels of modern finance. That grease is liquidity. For example, significant hedge fund positions are funded through borrowing in overnight money markets, that is, in the SOFR market. At the most basic level, liquidity is measured by the amount of bank reserves in the financial system. The chart you see on the screen shows bank reserve balances with the Federal Reserve. And you can see that this number has been moving down from about 4.2 trillion in 2022 down to about $3 trillion presently. Generally, around the $3 trillion mark is what market participants monitor very closely. In fact, Christopher Waller, in one of his speeches in 2024, had opined that roughly when bank reserves fall to about 10% of the total US GDP, that's when they really start becoming a little bit scarce. Money market rates are a great indicator of how tight or loose US dollar liquidity is. The SOFR chart, which you see on the screen, shows how regularly SOFR has been spiking over the last 12 months. Now, this spike is usually happening during quarter ends, and that's quite natural because this is when banks and depository institutions they typically do what is called as window dressing of their accounts. In other words, they're trying to make their balance sheets look better for regulatory ratio purposes. But the interesting bit is that outside of quarter ends and month ends, we have seen SOFR spike in the recent past mid-month as well. For instance, in mid-April over here and in mid-September over here as well. Once again, an indication of tight US dollar liquidity in the markets. This next chart shows the difference between the overnight SOFR rate and the overnight reverse repurchase agreement rate. As you can see over here, mid-September, SOFR spiked again, causing the spread between the SOFR and the ONRRP rate to once again spike up. In fact, Friday last week was especially relevant because 75% or 75th percentile of all SOFR trades happened at a rate of 4.26 or below. In other words, 25% of the trades were executed or conducted at a rate above 4.26%. Similarly, 99th percentile of the trades happened at a rate of 4.28 or below. In other words, 1% of the trade happened above 4.28%. Now, why is this relevant? As you know, when the Fed sets interest rate, it doesn't set a particular rate. It puts in a target. For instance, on 16th of September, the Fed changed the target range to be 4 to 4.25%. And if there are trades which are happening above 4.25%, then it's a problem. Admittedly, this is on account of tax payments and large bill issuances. So what you can see on the chart over here is the buildup of what is called as the Treasury General Account. This is the check-in account of the US Treasury, which it maintains with the Fed. And because the Treasury has been issuing a ton of bills, money or US dollar liquidity is getting sucked from the markets and it's getting deposited at the check-in account of the Fed at the Federal Reserve. Nonetheless, these spikes are meaningful and again, a clear indication of tight US dollar liquidity in the market. In fact, over the last couple of days, things have gotten even more interesting. On the last day of September, 75th percentile and 99th percentile rates were 4.31 and 4.38, well outside the upper bound of the Fed target range of 4.25. At the same time, rates have come back on the first day of October as well. How swiftly does this rate come back within the range of 4 to 4.25? And how many times or how quickly does it move outside that upper bound of 4.25 is something that money market participants and all market participants will be closely watching over the next few days and weeks. Also, it is not like the Fed doesn't have any tools to prevent money market rates from breaching that upper bound. It has what is called as the standing repo facility, a facility where market participants can come and borrow funds from the Fed at a certain rate, at a certain bid rate. And that rate is set at 4.25%, which is exactly the upper bound of the Fed's target range. And you can see participants did come to the Fed's SRF in order to borrow money, but the amount that they borrowed at September end was just about 5 billion. This was much lesser than the 50 or 60 billion that people were anticipating that banks might borrow from the SRF at the September end quarter. And in fact, this 5 billion was much lesser than the 11 billion which was borrowed at the end of the previous quarter. In summary, though, SOFR has been spiking with increasing frequency, and that matters. The last time this happened in September 2019, which was famously called as the repo market tantrum, the Fed had to once again engage in large scale quantitative easing in order to inject US dollar liquidity back again into the markets.